Hello and welcome to Ask for a Trend. I'm Josh Lipton, and for the next half hour, we are breaking down the trends of today that'll move stocks tomorrow. There's a lot to keep track of, so we're focusing on what you need to know to get ahead of that curve. Here's some of the trends we're going to be diving into. Well, stocks were little changed while investors waited to hear news coming out of those trade talks between the U.S. and China, but at the end of the session, all major indices did end higher. And we're giving you the download on the software sector. It is seemingly tariff-proof, but we're taking a closer look to see if that's truly the case. And can investors still capitalize on a sluggish housing market somehow? We're going to take a look at some real estate opportunities straight ahead. Well, Oracle gearing up to report fourth quarter earnings tomorrow, giving investors more insight into the software sector, which has largely been considered as tariff resistant. Joining me now is Rishi Jaluria, Managing Director of Software at RBC Capital Markets. Rishi, it is great to see you, especially on set live here. Let me ask you this. First question, big question, I think, for software investors who are listening right now. Many might consider the software sector, Rishi, which you know so well, as relatively tariff resistant. Now that we've gone through earnings season, you read through those reports, Rishi, we're in all those conference calls. Is that your takeaway, tariff resistance?
I think that's right. And Josh, always great to be with you, and especially in person in the studio. I think you're exactly right. I mean, the idea is you cannot actually tariff software as a service. There's no real mechanical way to do this. And even if you think about from a, quote, reputational standpoint, for most of the large software vendors out there, there aren't really good local alternatives to them as well, right? There aren't any good European alternatives to Microsoft or to Salesforce or anything like that. So I think we have been seeing that. However, what we also have been seeing is maybe some of the underlying cracks of this showing up, whether it's tariff talks and uncertainty impacting the actual end customer base, or whether it's just uncertainty leading to some issues overall as well. So,
and those cracks you're pointing out, in your opinion, Rishi, are those priced in at these levels?
You know, candidly, I don't think they are. If you look at it, the software index, the IGV, which is what we use to track, is at basically near all-time highs, in spite of the fact that we are introducing a lot of uncertainty into the equation. We don't know how this is going to play out, but I'm already starting to pick up in my conversations, increased deal scrutiny, longer sales cycles. There's definitely some of that sort of issue. And I think initially when we went through, especially the March quarter end earnings, it seemed like things were fine, but I worry that some of those cracks were offset by pulled forward business. And now I think we're going to see a little bit of that. I'm worried that just numbers and expectations may be a little bit higher than where they're actually going to shake out. And so I think we have to, it's a stock picker's market. We have to pick and choose our spots here.
Let me ask you, we talk about tariffs. What about the macro? What about expectations of slowing economic growth? That impacts your coverage universe how, Rishi?
Absolutely. And look, I mean, I think even when we think about recession sensitivity, and we've written a lot on this topic, even relative to recessions, software should be a little bit more resilient than other areas of the economy. It is a secular growth driver of really the global economy. We're still in very early stages on digital transformation. And by the way, the last time we had a really major recession, going back to 08, 09, it actually accelerated cloud adoption. And we're now in the middle of a new paradigm shift, which is AI. And there is a case to be made, especially when you think about efficiency gains and cost savings, that maybe, God forbid, if we do hit an economic slowdown, it may actually accelerate AI adoption.
Let's talk more about AI. What does AI adoption in the enterprise look like right now? What are the trends?
Yeah, look, the trends are, I would say, twofold. Number one is we are actually seeing not just up and to the right, but I think we've seen an inflection in enterprise AI demand really over the past 6 months and 9 months. And I think it's a function of the technology has just gotten better. The use cases are there. There's more urgency from companies and boards. But also, I think the other really interesting trend that we're starting to pick up on is we're seeing adoption of AI in kind of more, quote, traditional industries. Because you'd expect the technology sector to see huge AI demand. You'd expect financial services to kind of follow behind that. But we're seeing it in industrials and manufacturing, retail, healthcare, food services. And I think that's because of this viewpoint that can generate real margin expansion. So if anything, the adoption of AI is maybe tracking ahead of previous technological waves.
Interesting. We talk about the trends and themes. Let's talk about some picks. Yeah. You recently downgraded Salesforce to sector perform. So you went to a hold, Rishi. How come?
Yeah, to me, I mean, the triggering event was really the Informatica deal. I think it's a non-core asset. I don't think it was a quality acquisition. I don't think they overpaid for it by any stretch. But it's more, what does this represent to me? Because if you remember where the frustrations with Salesforce began, it was too much M&A, not integrating.
Mark Benioff making big deals.
Exactly,
right.
and I worry this is a return.
But
to
then
that.
he got religion, I thought. Right?
He did, right? And I think that's what made me positive on Salesforce and why I wrote it, all the way up for a few years. But now I'm worried it might just be going back to their old ways. And so, I think we need to get through this Informatica deal, see how it pans out. What do they do in terms of integration? How does this impact the roadmap for Agentforce? I think there's too much uncertainty for me to get behind buying the stock right now.
Another name I know you're lukewarm on is Oracle, which is on deck, reports tomorrow. How come? Why is that the equivalent of a hold for you?
Yeah, to me, I think I have a little bit more skepticism around OCI, their cloud platform that competes with AWS.
How come, Rishi?
To me, I think the thing is they've been getting a lot of, I would say, temporary benefits or some non-recurring tailwinds. And really the biggest one has been excess capacity, that everyone just needs as much capacity as possible for AI workloads, including Microsoft and Meta. And Oracle happens to be in the right place at the right time with all this capacity and with the GPU allocation they're getting from NVIDIA. The problem is, as those tailwinds start to dissipate and companies like Microsoft think about bringing that capacity back in-house because it has better economics, better performance, better control, that means a lot of that business will start to dissipate for Oracle, and I don't think the growth rates we've seen in OCI are sustainable.
You mentioned Microsoft, which I know you still have a buy on.
Yes.
How come, Rishi? Why does that one move higher from here? What are the catalysts ahead?
Yeah. Look, so Microsoft to me is probably one of my favorite names out here. In spite of the fact that the stock has performed well, we've seen Azure accelerate. I really think, number one, they're in a league of their own when it comes to AI. They're not just monetizing it through the OpenAI relationship. They're actually innovating. They're bringing AI throughout the stack. And even a product like Office Copilot, which I think a lot of people had been skeptical on, is actually getting real traction to the tune that it's in the billions of dollars of ARR already, growing, by my estimates, about 300%. So there's real traction that they're getting throughout the AI stack that feels very underappreciated to me by the street. And it's coming at a reasonable valuation at about 33 times GAAP earnings. So I think there's a lot of room up and upside from here.
Now, when your clients ask you, though, Rishi, okay, but what are the risks I need to think about with Microsoft? You say what?
I think it's losing that AI leadership. There's clearly an AI multiple in Microsoft right now. And if they can't execute on this, or we start to see disruptors or disaggregators start to take share, that would be a worry. And we're keeping our eyes very, very closely on the private markets for exactly this reason.
Rishi, we are always lucky to have you on the show. Thank you, sir.
Thank you so much.
Appreciate it. Well, the S&P 500 and NASDAQ have records back in sight amid trade talks between the U.S. and China. For more on the trading day takeaways, let's get to Yahoo Finance's very own Jared Blikre. Jared.
Thank you. We got to start with the Kahuna S&P 500 and 2%. What does that mean? It was not up 2% today, just a fraction of that. In fact, it is less than 2% away from its record highs, and it's up a little bit more than 2% year to date. And that's not a big number, but when you consider where it was coming from, those April 8th lows, that's a far cry from it. So I'm going to do something a little bit scary here. I'm going to make all these numbers, all these boxes turn to red. And there we go. This is how much they are off of their record highs. So the S&P 500 down 1.77%. What you're going to notice is we got three sectors: communication services, tech, industrials, that are off less than 1% from those highs. Communication services and tech, for instance, have not hit their records in quite a while. Here's the year to date. You can see it's right up against, so you can draw the line across, but didn't quite hit it just yet. Industrials has hit a record high recently. And I just want to show you what's happened over the last 3 days. We'll put some percentage gains back in there. A broad swath of sectors have done pretty well: energy, discretionary services, tech, and healthcare. And when I take a look at some of our leaders here, you're going to see some pretty big numbers. ARK Innovation Fund, that's a lot of small caps plus Tesla, Bitcoin, small oil, chip stocks, Mag 7, regional banks, gambling, transportation. The next row, biotech as well. All of those are up 3 days in a row. So I'm encouraged by this. We're just not seeing it show up in some of the majors yet, like the S&P 500.
All right, so maybe not the biggest index returns for the U.S. Where is the juice then, Jared?
Oh, good question. And that leads to point number two. Earth minus USA. So you kind of got to go abroad. And I think everybody's heard about Germany and some of the other country ETFs that have done so well this year. And let me just put this up on a board. I was doing this in depth on Catalyst earlier today, so I'm not going to spend too much time on it. And here is the year to date. So Poland up almost 50%. That's EPOL. That's a country ETF. 47.7%. Then we have Greece, and then we have EWP, that's Spain, and the list goes on. So all the way down the line, you had a lot of these countries breaking out to record highs. But also over the last 2 years, not all of those are at records, by the way, but over the last 2 years, we've also seen a lot of outperformance here. SPY is a US, and so SPY is doing better than a couple of these, including Japan and the UAE. But you take a look at Central Europe, like Poland is just an incredible success story here.
Finally, let's do a quick crypto check while I have you.
You bet. All right, so Bitcoin's $2,000 a day rally, $2,000 a day rally. And so it dipped to 100,000, then it shot up to 110,000 in 5 days. And I'm gonna show you the crypto board in a second. And it's not just Bitcoin. I was kind of, wow, look at that, 324%. Here we go. This is what happened in the last 24 hours, and I'll show you the last 5 days, which actually, let me show you the last 10 days so you can see that big dip there all the way to 100,000, and here's the 110,000. I was not complaining, but I was saying Ethereum was kind of stuck in a range here, but look at what Ethereum has done today. It's up 6.8%, and it has finally broken out of this big range here. Let me put a longer term chart. Year to date, that should do it. Here, this is a 4-week trend, sideways trend that we just broke out of. I was also saying and noting that we haven't seen a lot of participation from some of the altcoins, but let me just show you the last 3 days here. It looks like they're picking up too. I haven't seen necessarily a big catalyst, and I don't know where the strength is coming from necessarily, and maybe it's Bitcoin dragging some of these guys kicking and screaming. But when you have a broad base of strength like this in the altcoins, I have noticed that the Bitcoin rallies tend to go further. So we don't have Bitcoin at record highs just yet, but if it breaks through and get broad participation, it's just like the stock market, just fuel for the up thrust.
Finally, what about those metal commodities that we talk so much about here?
Yes. So I have been focusing on gold, silver, and also copper. Here's copper. Let me just show you what's happening with palladium, and maybe a 5-day view is going to show better. There we go. Palladium or platinum, excuse me. Platinum futures is what I was looking for. This is a year to date, and you can see we were stuck at this level here, couldn't bump up. Then we got above it just recently in late May, and then we took off in June after using it as support. That is a textbook breakout. And if I show you a 10-year chart, you can see, well, that's a whole lot of sideways action too, but we are right back up against these highs here. So we break beyond this, we're seeing a breakout in platinum futures. I've been covering what's happening in silver. Silver is also broken out to 12, 13-year highs, something like that. This is a 10-year chart. And if I show you the max, you're going to see we haven't seen these prices since 2011, 2012. Gold still kind of trading in a range, and copper hasn't really caught up just yet. But overall, the metals complex has been a source of strength. And you're not even seeing that on the back of the dollar decline. The dollar has been kind of treading water here for a week or 2 weeks. So that just means if the dollar were to sink even more, that would be more fuel for the rally.
All right, Poland, Bitcoin, platinum, we hit it all.
What didn't we talk about,
It's all
Josh?
there. Thank you, Jared. Appreciate it. Stick around. Much more Ask for a Trend still to come. Weakness in the housing market lingers amid high interest rates and affordability issues. While that is not likely to change anytime soon, real estate investment trusts are seeing attractive entry points. Mizuho Managing Director and analyst Hendel St. Just joins us now to discuss. Hendel, it is great to see you. So maybe start big picture, Hendel. I'm curious, you think about REITs as a sector. Are you constructive on that sector, Hendel, given these concerns that we have about slowing growth and rates where they are?
First of all, thanks for having me, Josh. Pleasure to be here. REITs cover a broad spectrum of the economy, and so I think it wouldn't surprise you to hear that there's pockets of REITs which we have very high conviction on, and parts of REITs where I think there's some doubts about demand and pricing power. Certainly on the more positive side, data centers is a place where there's lots of demand and clear pricing power. Housing within single-family rental and apartments seems to be faring well, but there are some concerns about other parts of, absorption for industrial and certain other asset classes. So it's a bit of a mixed picture depending on what subsector you're asking about, but we are constructive overall on rentership, housing, single-family rentals, and apartments.
Why, Hendel? Walk us through that thesis.
So I think when you step back and think about where we are in the housing picture, clearly there's been tepid demand for housing. You heard it from the home builders. Consumer confidence is fairly weak. Affordability is low because of years of rising home prices. Interest rates are pretty high relative to where they've been the last couple of years. So affordability for a lot of folks buying a home is just out of reach. And so that creates a clear tailwind for the rentership side of the equation. And we've seen that benefit the single family rental and apartment portfolios with turnover levels remaining near historic lows, occupancies being above average, and the landlords being in a position to move rents broadly, not in every region, but broadly.
What's a smart way to play that trend then, Handel?
So I think, stepping back, we think the dynamics for single family rentership have several years of sustainability. First, there still is that unaffordability aspect that we talked about. On average, it's about 50% more expensive to own a home in this country versus renting, and that varies by market. On the coast, it wouldn't surprise you to hear in New York and say San Francisco that it's nearly 2x. There's been broadly an underproduction of homes in this country over the past decade. Household formation that has exceeded the rates of new supply being added to the for sale market. And we think that, in the current environment of uncertainty with tariffs and the macro, consumers are making, decisions more in the shorter term. It's easier to engage in a 12 or 24-month lease contract than to buy a home if you can afford it.
So we talked housing. What about shopping centers, Handel? Do you see opportunity in that sector?
We've liked the shopping centers here for the past couple of years. The sector has certainly been on a multi-year run, benefiting from historically low supply. There was a purging of weaker tenant credits in the aftermath of COVID. So the tenant credit picture has been fairly benign the last couple of years. A few more names have been popping up here, but overall, it's manageable. The companies have reserves in place more than sufficient to incur these incremental spaces being given back. And so the landlords have pricing power. Supply is nowhere near where it is in other subsectors. And so we think it's a space where landlords can continue to enjoy pricing power for several years to come.
Is there a name specifically, Handel, in that space you prefer?
Absolutely. Our top pick today is a company called Regency Centers, ticker REG. They are a national shopping center owner. Their demographics in terms of household income and just the value of single family homes in the neighborhoods that they own and operate assets in is in the top right quadrant, where you want to be in this space. They have below average exposure to a number of the tenant credit watch list names, Joann's, Party City, Big Lots, et cetera. Their balance sheet's in fantastic shape, and they have an above average growth profile with embedded growth from leases that have been signed, which are now starting to cash flow.
Handel, great to have you on the show today. Thanks so much for your time. Appreciate it.
Thanks, Josh. Great to be with you.
Stick around. Much more Ask for a Trend. That's still to come. Wall Street's fear gauge is sliding steeply these days, coming against the backdrop of President Trump's ongoing trade wars. Yahoo Finance's Julie Hyman joins me now with a closer look in our chart of the day.
It's avoiding the worst case scenario in trade wars that has sent volatility back down here after the spike that we saw after the reciprocal tariffs were first announced. And markets, for lack of a better term, freaked out because it was unexpected, the numbers that we saw. So here you have, over the past 2 months, what we have seen in terms of the drop in volatility. It's about, from peak to trough, again, over the 2-month period, about a 35-point drop. That's the third largest that we've seen on record, dwarfed only by what we saw in May of 2020 and then going back to December of 2008. All of this according to Bespoke Investment Group. So why should we care, you might ask? And that's because of what we see, that what happens after these big drops in volatility. What Bespoke says is that seeing a drop like this would normally imply that we would have seen an even bigger recovery in stocks since then, perhaps approaching as much as 50% instead of the 20% or so that we have seen climb from the low. So what now? Bespoke says it doesn't mean a lot for short-term stock returns, but they say, again, if you go back and look at the history of when we see patterns like this, if you go out in the 6 or 12-month periods, you do tend to see more positive returns for stocks. Like with anything else, a lot of caveats here. There are no guarantees. Past performance does not guarantee future results, but Bespoke specializes in looking at these types of historical patterns to try to figure out what comes next. In their view then, and as history might indicate, 6-12 months out from here, we could see stocks higher than they are today, Josh.
Thank you, Julie. Let's take a look at what's trending now after hours. GameStop, Dave & Buster's, and GitLab all moving following their earnings. Going to start here with GameStop. Company reporting net sales of hardware and accessories in the first quarter that did miss analyst estimates as Q1 revenue fell 17%. GameStop announced they purchased over 4,000 Bitcoin between May 3rd and June 10th. And the meme stock also reporting an operating loss of $10.8 million, which does include a $35.5 million of impairment charges. We're also watching Dave & Buster's here, reporting first quarter earnings that missed estimates. Company's net sales falling 17% year over year. The arcade and entertainment venue sharing revenue on par with estimates, but shares are falling during after-hours trade. And GitLab is also on our radar. Shares dropping after missing expectations with its second quarter forecast. Revenue was up 27% for the software company in the first quarter. Outlook for the future looking flat, with revenue expectations falling short for the next quarter. Well, that's a wrap on today's Ask for a Trend. Be sure to come back tomorrow at 4:30 p.m. Eastern for all of the latest market moving stories affecting your wallet. Have a great night.